In this video, I show you how to get better trades by using a trading plan, and I walk you through the steps that it takes to create trading plans. So let's start with the first example, and we are starting on the higher time frame. Your higher time frame can be the 4-hour, it can also be the daily or the weekly for longer term trading. Here we're using the 4-hour time frame. And what you're doing here is generally for a trading plan, you want to establish the overall trend direction. You want to see, is the market in an uptrend, is it in a downtrend, or has it been moving sideways? A very simple, easy trick is to just look at where the price has started on the left side of the chart, and then where is it in the relation to that. So we can see on the left side of the chart, the market was here at the bottom left, and now we are here at the top right. I know this is a very simple way of doing it, but you can see that this helps us understand that the market has been in an uptrend, and then recently the market has been trading sideways. On the higher time frame, you also typically want to draw your support and resistance levels. And we can find here a very good resistance level that the market has been struggling. And then we want to define our trigger points. What makes us go bullish? What makes us go bearish? And when do we stay on the sidelines and don't do anything? So in that case, I think it's very straightforward. We are in an uptrend. We want to look for long opportunities. And typically you want to wait for the market to clear resistance levels on the way up. So we don't want to get long until the market has not broken this level. We want to get long after the market has broken out here above the resistance. And although this is very simple, a lot of traders struggle with going to the higher time frame. Many never leave the lower time frame, and then they will miss those important levels. A lot of traders trade into big support and resistance levels without even being aware of it. So going to the higher time frame at least once or twice a day can really help you in your understanding. You're still on the higher time frame until the market has broken out and has cleared the resistance. At that point, you can see the market traded above the resistance. There was no immediate fallback. The market also rejected here with the pin bar, and this is a good bullish signal. At that point, we don't get long right away, but we go to the lower time frame to find our trading plan for the entry. And typically what you do is on a 4-hour, you can go either to the 1 hour for your entries, but you can also have a more of a day trading approach where you go from the 4-hour to the 30-minute, like in this case, but you can also go to the 15-minute and 5-minute. It really depends on your preferences. So on the lower time frame, we want to find our entry trigger. What gets us in the trade? What signals trade entry? And what I'm using here is the daily high-low indicator. I made a few videos. Just check my latest videos and I explain this indicator and how to use it. But basically it just plots the last daily high and the last daily low on your price action. And a very simple way of doing it would be to wait for the market to clear the daily high. Here you can also see we have a short-term resistance. We don't only have the long-term resistance on the higher time frame, which we have already cleared, but we also have this short-term resistance. And you want to typically get into a trade when the market clears a daily high and then also takes out this resistance. You can also have an add-on rule where you say, I want to have a specific type of breakout. I want to get into a breakout when I have a larger than usual candlestick. Larger breakout candles are typically preferred because they show that the market is really undergoing an important shift. This happened here. So this could be your entry trigger plan, which has been now taken care of and it has now been fulfilled. A very important part of a trading plan is also your stop loss and your target plan. Every trade should have a plan for the stop loss so that you know when to get out, when is your trade idea proven wrong. And stop loss can be placed in many different ways. For example, we could place the stop loss here below the resistance. Other traders say they want to place their stop loss below the breakout candle. Some traders may even say, I want to put my stop loss all the way above or below, in this case, the last swing low. This is really up to you, but you need to have a plan for your stop loss so that your stops over time are consistent and they follow the same rules. The more consistency you have in your trading, the better it is. Also, make sure to check your news calendar. A lot of traders run into the problem that they don't check their news calendar and then they run into high impact news. They don't know what is going on and then they get taken out. Although their trade idea was okay, they was right, they followed the trading plan, but they didn't check the news calendar. And especially on the lower time frames, high impact news can have a huge impact. And then afterwards, you can see this is the final outcome. The market trended higher. The market moved into the daily high, kept going into the daily highs, and kept pushing and advancing higher. A very important part of a trading plan is also to have an exit plan. What would signal a premature or an early trade exit? It is really important that you also cover those things, and I want to show you all the parts of a trading plan here. When you're creating a trading plan, make sure that you have covered all the parts. First of all, you want to check the higher time frame conditions. This is a very important part of a trading plan because it forces you to go away from your lower time frame, which many traders don't do. They always just stay locked in their lower time frame, and then they miss the bigger picture. You want to see the entry trigger rules. What gets you in? Is it a breakout? Is it a pullback? What are your conditions? What are the rules? What are the tools that you're using? Also, really important, how do you set your stop loss? And how do you take profits? Where do you take profits? Do you have a fixed reward to risk ratio? Do you have a trailing stop loss approach? Make sure that you are very clear about how you do those things. Risk management. How much do you risk per trade? Is it 0.5%? Is it 1%? Do you scale into a position? Whatever it may be, make sure that you have written it down in your trading plan so that every trade follows the same principles. And then also make sure to have a trade management plan. Do you use a trading stop loss? How do you trail your stop loss? Do you use a moving average? Do you use pivot points? Do you trail it behind the last daily high, the last daily low, below swing points or above swing points? And then finally, an exit plan. When do you exit your trade early? As a day trader, it makes maybe sense to have an end of day exit so that no matter what has happened to your trade, at the end of the day, you take your exit and you close your trade. As a swing trader, you could say, okay, at the end of the week, I close my trade and then I'm out no matter what. It's very important that you have covered those bases in your trading plan. Before we get into the next trading plan example, let's compare the benefits and the pitfalls of not having a trading plan. If you don't have a trading plan right now, most traders will probably not have a trading plan or not have a good enough trading plan. You will have lots of noise in your trading. Noise can be just changing rules all the time. It can be jumping around time frames. It can be system hopping. The more noise you have in your trading plan, the more impulsive and the more emotional you will be in your trading. Also, the more likely is it that you make emotional trading mistakes. If you don't have a plan, you have no guidance in your trading plan, you will typically also have no confidence in what you're doing, because if you are always changing your rules, if you're always changing your approach, and every trade is a little bit different than the one before, you have really no way of identifying and validating how effective your trading is. And you also have no structure. You're basically just running around like a headless chicken, chasing your old tail, and then hoping to somehow find profitable trades and being lucky. On the other hand, once you have a solid trading plan where you have covered all the parts of a trading plan, your trading will be much more calm. You can have more consistency. You have overall less noise. All of your trades should look very similar once you have a trading plan, and this brings you peace of mind. You are much less emotional. You don't make the emotional mistakes. You're not as impulsive. You don't jump in and out of trades. You don't revenge trade. You're not over leveraging, for example, as well. You have more confidence because you're able to track your trades in your trading journal much more effectively, because all have the same premise, all follow the same rules, and then you can find out in your trading journal, hopefully it's edgewonk, which of the rules are contributing to your success, which rules are not helpful, and then also you can tweak specific rules over time and see the impact on your trading performance. And overall you have more structure, and this will also lead you to spending less time on your trading. When you know exactly what you're doing, how you're doing, you have a very set routine that you follow every trading day, then over time you will spend less time because you know exactly what to do, you know when to look for the charts, you know what to look for at the charts, and that will be a huge time saver and overall just have a huge benefit on your trading. Let's take a look at the trading plan number 2 and another example of how we can create a trading plan. We're starting on the higher time frame, and here we also want to identify the trend direction. And what do we see? The market started here with an uptrend, with a downtrend. The market trended lower. We are using here the 4-hour, and this is the 50 EMA. Then the market seemed to have rolled over. The market made here this fake out. Then we are starting to make higher lows. And now the market is in an uptrending scenario. We are above the moving average. We are above the pivot points here. And that is very important to understand on a higher time frame. You are in an uptrend. However, you have currently already seen a huge bullish move. And a lot of traders will then make the mistake of chasing the market. However, if you want to trade long, if you want to participate in this uptrend, you are much better off typically waiting for a pullback. So your trading plan could include the following. You wait for the market to pull back. You don't want to chase. You recognize and you accept that you're in an uptrend. So you are more looking for bullish opportunities than bearish opportunities, but You want to get a better entry price. You want to wait for a pullback. And then you can use the tools that are displayed here, for example. You could say, okay, I wait for a pullback. The pullback has to reach the daily pivot, or it has to reach here the EMA. You could also work with previous support and resistance. Here might be a support, a resistance area that you want to see retested. And those are all the things that you can implement in your trading plan. And the trading plan follows this if-then format. So if the market moves lower, then I will start looking for bullish opportunities. And this if-then format can really help you improve your trading process, because you know exactly what to do. You know at this point in time, there's nothing for you to do. You have to wait for the market to pull back. You don't want to chase. This is not your system. And this can already bring you a lot of confidence and peace of mind. Now you can see the market has moved back into the pivot. We are at the moving average. We are finding support here. And now your higher time frame conditions are met. And then we go to the lower time frame. On the lower time frame is usually where you find your entry criteria and your entry trigger. So now we go to the 15-minute time frame. We can see this is our pivot. Here's also a resistance area. We have one resistance and two resistance points. We can use here this level as an entry, right? We want to see the market clear this area and maybe also retest it. That could be your lower entry plan. So just because your higher time frame has met your conditions, typically that's not enough. You want to go to the lower time frame where you then fine tune, so to speak, your entry plan. And then this is also where you take your entries. Here you can see the market cleared here the resistance. It retested as support. And to have a successful retest, you want to wait for the market to clear the high. A retest is usually only valid once the market is moving higher. A lot of traders make the mistake that as soon as the market is breaking out and then hitting the previous resistance now as support, they jump in. But in my experience, I would wait for the market to make a higher high that confirms the trend structure. And this happened here. You can see it would have been the right call to wait. The market moved lower, fell back into this pattern here. We moved back all the way below this resistance that we have identified previously. This is what we would call a liquidity run or a dirty retest if you have watched my previous videos. So you can see we get into the trade here. The market is clearing the high. The market confirms that we are making higher highs in an uptrend. And then you can have your stop loss trading plan. You could say, okay, in this case, my stop loss should be all the way here below the pivot point or maybe even below the swing point. Whatever your stop loss trading plan is, make sure that you have one and that you follow it over time consistently. Every trade should have the same stop loss trading plan. And then you can see the market cleared the resistance here and then the uptrend unfolded here. The market stayed mostly above the moving average. We stayed above the pivot points. Here may have been another retest opportunity to get into an additional trade as well. And then the market moved higher and unfolded. And this is how you can then create a trading plan. So to recap, what you do is you start on the higher time frame. You look for the overall trend direction. You draw your higher level support and resistance levels there. You wait for your conditions on the higher time frame to be met. Then on the lower time frames, you wait for the entry trigger, and then you follow your stop loss and you take profit and your target plan on the lower time frames typically. Don't forget to check the news calendar, make sure that you have rules for your position sizing as well, and then you have a complete, well-rounded trading plan.